let's see the comprehensive problems in the area of admission of partners. So there are two partners, A and B. They were partners sharing profit and losses in the ratio of 2:1. The balance sheet as on 31st/12/2020 was as follows. Creditors 1,31,800, liability side capital 60,000 A, B 40,000, total 1 lakhs. Then cash, asset side, cash 2,400, debtors 19,400, stock 40,000, machinery 17,000, building 1 lakh. The total of the balance sheet is 2,31,800. Additional information. They admit C as a new partner. C is a new partner. Then his share is 1/3. Sacrifice made by the partner is not given. Then what are the conditions we have to follow while preparing the balance sheet? She should bring in rupees 30,000 as capital. The stock and machinery be depreciated by 10%. 5% provision on debtors for doubtful debts. Value of building be appreciated by 19,000. Prepare necessary ledger account and balance sheet after C's admission. So you are asked to prepare balance sheet after the C's admission. Let's prepare. First, let's prepare the new profit sharing ratio. Okay, we have to calculate the new profit sharing ratio. What is the old ratio? Old ratio is 2:1. A and B. A and B old ratio is 2:1. C's share is 1/3. The sacrificing ratio is 2:1. Old ratio becomes the sacrificing ratio because the sacrifice made by the old partner is not given. Then the next one is calculation of new ratio. How they are going to calculate, how they are going to share their profit. Let us assume the firm's profit be 1. Firm's profit be 1. Then share of C is 1/3. So remaining profit is 1 minus 1/3, that is equal to 2/3. The remaining profit is shared between A and B in the old ratio. So A's new ratio is equal to 2/3 into 2/3. 2/3 is the old share, 2/3 is the remaining profit. So 4/9. B's new share is equal to 1/3 into 2/3. His profit sharing ratio is 1/3. Remaining profit is 2/3. So 2/9. C's share is, that is already given 1/3. This is denominator is 9, and so it should be multiplied by 3/3. So 3/9. So the new ratio is equal to 4:2:3. The first step is to calculate the new ratio of the partners. The new ratio of the partner is 4:2:3. Then the next step, we have to prepare revaluation account. So what are the information that are given? Building be appreciated by 19,000. If the asset value is appreciated, it should comes under the credit side. So we have to write 19,000. Then stock should be depreciated. Stock machinery should be depreciated by 10%. The book value is 40,000. So 40,000 is to 10% is 4,000 depreciation. So asset value is decreasing, and so it should come under the debit side. Then machinery 70,000. 70,000 into 10 is 7,000. Then provision has to be created on the debtors. Debtor value is 14,000. So 14,000 into 5 is 970. The total of the credit side is 19,000. And the remaining amount, that is a profit, is revaluation profit is 7,030. That 7,030 should be distributed among A and B in the profit sharing ratio of 2:1. A's share is 7,030 into 2/3, that is 4,687. B's share is 1/3 into 7,030, that is 2,343. This is the revaluation profit that should be transferred to partners capital account in the old profit sharing ratio. Revaluation profit should not go to the hands of the new partners. Then we have to prepare capital account. The capital account of all the partners should be prepared. Simultaneously we can prepare A, B, C, A, B, C. Then by balance brought down. A's capital is 60,000, B's capital is 40,000. Then cash, C brought 30,000. Cash account data to C's capital account, journal entry. So by cash is C's capital account should be credited with the cash of rupees 30,000. Then revaluation profit should be credited to old partners in the old ratio that comes under the credit side of A and B capital account, that is 4,687 and 2,343. So the total of the A, B, C is 64,687, 42,343, 30,000. So here we don't have any entries, and so this balance will become the closing balance. The closing balance of capital account of A is the 64,687, 42,343 and 30,000. This is the capital account at the end of the, after the admission of C, okay, or at the time of admission of C. This is the capital amount of A, B, C. This is the balance sheet of A, B, C as on 31st/12/2020. Under the liability side, creditors given in the balance sheet is 1,31,800. There is no adjustments for creditor. So the same amount we have to enter, that is 1,31,800. Then capital already we have calculated. A's capital is 64,687. B's capital is 42,343. C's capital is 30,000. So the total capital of the firm is 1,37,030. Then go to the asset side. Cash, opening balance or the cash balance in the balance sheet is 2,400. So with that balance we have to add the C's capital. C brought cash 30,000 rupees as his capital, and so we have to add 30,000. So the total cash balance is 32,400 after the admission of C. Then debtors, less provisions. So we provide 5% provision on debtors. So 19,400 minus 970 is 18,430. Then stock, the book value of stock is 40,000. From that we have to deduct 10% depreciation that is given in the adjustment. So 40,000 minus 4,000 is 36,000. Machinery balance sheet value is 70,000. Depreciation is 10%. So 17,000 minus 7,000 is 63,000. Building is 1 lakh rupees in the balance sheet. We have to add the 19,000 because it is appreciated by 19,000 that is given, and so we have to add 19,000. So the value of building is 1,19,000. So the total of balance sheet after C's admission is 2,68,830. In this way we have to prepare balance sheet at the time of admission of a new partner. This is question number 2. Following is the balance sheet of X and Y. Share profit or losses in the ratio of 3:2 as on 31st/3/2018. X capital 10,000, Y's capital 12,500. Okay, so there are two partners, X and Y. They share profit and losses in the ratio of 3:2. X capital amount is 10,000, Y's capital account is 12,000. Creditor is 7,500, building is 15,000, stock value is 7,500, debtor is 5,000, bank is 2,500. So the total of the balance sheet is 30,000. Additional information given for the above problem is, on the date, Z was admitted as a partner. New partner name is Z. He will pay 12,500 as capital, 5,000 as goodwill. So he paid 5,000 rupees for goodwill. So the method which we are going to follow is premium method. So the share of new partner is 1/5. Assets are revalued as building rupees 20,000, debtors 4,500, stock 7,000. Prepare revaluation account, capital account and balance sheet. First, let's calculate the new profit sharing ratio. Old partner name is given, that is X and Y. Old ratio is 3:2. New partner name is Z. New partner share is 1/5. Let the firm total profit be 1. Sacrifice made by the old partner is not given. So the sacrificing ratio and old ratio is one and the same. So the sacrificing ratio is also 3:2. After the admission of Z, the remaining profit is, the Z share is 1/5. So 1 minus 1/5, that is 4/5. The assumption is 4/5 should be shared between X and Y in the ratio of 3:2, same ratio, old ratio. So the remaining profit is 4/5. And the old share of X is 3/5. So 3/5 into 4/5 is 12/25. Then Y's new share is, the remaining share is profit in the firm is 4/5. The ratio, old ratio of Y is 2/5. So 8/25. Z share is 1/5 is given. The denominator is 25. In order to get the denominator, the 1/5 should be multiplied with 5. So it should be multiplied with 5/5. So we will get 5/25. So the new share is 12:8:5. The next one is treatment of goodwill. X pays premium rupees 5,000 rupees. The premium is meant for the goodwill. Okay. The sacrifice which is made by the partners towards the admission of the new partner is considered here. In return, the new partner brings a premium. Okay, that should be shared between the old partners in the sacrificing ratio. Okay, that should be shared between X and Y. Old partners are X and Y in the sacrificing ratio. Here the sacrificing ratio is old ratio because the details about the sacrifice is not given. The entry would be goodwill account debtor to X capital account to Y capital account. Goodwill is 5,000 rupees. 3:2 is the ratio. So X capital is 3,000. Y's capital is 2,000. Being premium distributed among old partners in the sacrificing ratio. The next step, we have to prepare revaluation account. So the first one, provision for doubtful debts. The debtors which is given in the balance sheet is 5,000, but in the adjustment, revised value of debtor is 4,500. So the provision for doubtful debts we have created is 500. Okay, 5,000 minus 4,500 is 500. Then stock value given in the balance sheet is 7,500. Revised value is 7,000. So it is depreciated to the extent of 500 rupees. If the asset is depreciated, the revaluation account, it should come under the debit side of the revaluation account. If the asset is appreciated, then it should come under the credit side of the revaluation account. Then building, the balance sheet value is 15,000 and the revised value is 20,000, and so it is appreciated to the extent of 5,000. So it comes under the credit side, that is building is 5,000. Then the balance is 5,000 is the total amount of the credit side. Here we have only 1,000 rupees. So the balance 5,000 minus 1,000 is 4,000. The 4,000 should be distributed among the old partners in the old ratio. Old partner is X and Y. Old ratio is 3:2. So 4,000 into 3/5. That is 2,400. So 2,400 should go to the capital of X, and 4,000 into 2/5, 1,600 should go to the capital of Y. In this way, we have to prepare the revaluation account. The next account is capital account. By balance brought down, X 10,000 rupees, Y 12,500. Z brought cash for capital 12,500. Total cash he brought is 12,500 for capital, 5,000 for goodwill. Okay. So that is distributed among the old partners in their sacrificing ratio, that is 3,000 and 2,000. Okay. For capital purpose, he brings cash for 12,500, that should be written here. Okay. Then by revaluation profit 2,400, 1,600. Goodwill, that is goodwill account data to X capital account to Y's capital account is 3,000, 2,000. Goodwill is distributed among the old partners in their sacrificing ratio. So the total capital balance of X is 15,500, Y is 16,100 and Z is 12,500. So the balance of the partner's capital is X 15,400, Y 16,100 and Z 12,500. Then balance sheet of X and Y and Z as on 31st/3/18. Capital. X capital is that comes under the liability side. X capital is 15,400, Y's capital is 16,100, Z capital is 12,500. The total capital of the firm is 44,000. Creditors, there is no adjustment and so we can write 7,500. Building. The balance sheet value or book value is 15,000. Revised value is 20,000. So the appreciation is 5,000. That should be added. Then debtors 5,000. Revised value is 4,500. So less provision is 500. Then stock 7,500 and revised book value is 7,500. Revised value is 7,000. So 500 is depreciation. That should be debited. Then bank. Opening balance or the bank balance in the balance sheet is 2,500. We have to add the Z capital plus premium. Z brought 17,500 capital, okay, 17,500 worth of cash and so that should be added. Here it is working is here. Balance sheet balance is 2,500. Capital amount she brought is 12,500. Goodwill, for goodwill he brought 5,000. So the total amount is 20,000. That should be written here. Okay. So the total of the balance sheet is 51,500. 51,500. This is the way to prepare balance sheet after the admission of Z. Next question. Adjustment of capital. Sun and Moon are partners in a partnership firm sharing profit in 3:1. They admitted Star as a partner for 1/4 share in future profit. The Star was to bring 60,000 for capital. The balance sheet of Sun and Moon on 1st April 2021, the date on which Star was admitted was as follows. Balance sheet given in the problem. Liabilities, creditors 70,000, capital Sun 50,000, Moon 80,000, total 1,30,000, general reserve 30,000, cash 10,000, debtors minus provision for bad debts 34,000, stock 30,000, investment 26,000, plant and machinery 70,000, land and building 40,000, total of the balance sheet is 2,10,000. Additional information, value of goodwill 24,000 but no goodwill appears in books. Liability of 1,200 included in sundry creditors was not likely to arise. Provision for bad and doubtful debts was found to be in excess by 400 rupees. Land and building was valued at rupees 65,000 and plant and machinery was valued at rupees 60,000. Capital of the partners be adjusted on the basis of Star's contribution of the capital to the firm. Excess or shortfall, if any, be transferred to current account. Prepare revaluation account, capital account and balance sheet of the new firm. The first one is we have to calculate the new ratio. Let the profit of the firm be 1. Star's share is 1/4. So the remaining share, the sacrifice made by the old partner is not given. So the remaining share is 1 minus 1/4 is 3/4. We have the assumption is that the remaining profit should be shared between the old partners in the old ratio. The old ratio of the old partner is 3:1. So Sun's new share is 3/4 into 3/4. 3/4 is the remaining profit. 3/4, another 3/4 is the old ratio. So 3/4 into 3/4 is 9/16. Then Moon's new share is the remaining profit is 3/4. His old share is 1/4. So 3/4 into 1/4 is 3/16. Star's share is 1/4. The denominator is 16 and so it should be multiplied with 4/4. So if you multiply 1/4 into 4/4, you will get 4/16. So the new ratio is 9:3:4. The sacrifice made by the partner is not given and so the old ratio becomes the sacrificing ratio. The next one is treatment of goodwill. The total capital which Star brought is 60,000. The total value of goodwill that is given in the adjustment is 24,000. So star's share of goodwill, star is given 1/4 share. 24,000 into 1/4 is 6,000 rupees. But he fails to bring 6,000 rupees. And so here the firm is following the fluctuating capital method. The partner's capital account should be debited and credited respectively. So the new partner capital account data to old partner's capital account in the sacrificing ratio. New partner capital is 6,000. The old partner's capital in the sacrificing ratio is 3:1. If the 6,000 is distributed among the old partners according to the ratio of 3:1, Sun capital account should be credited with 4,500. Moon's capital account should be credited with 1,500. So what is the effective capital of Star? He brought, even though 6,000, he fails to pay 6,000 rupees, 60,000 he brought, but he failed to pay 6,000 rupees for goodwill, and so we have to debit 6,000 rupees from his capital account. If we deduct 6,000 from 60,000, we will get 54,000. This should be the effective capital of the new partner. The effective capital of the new partner should be considered while calculating the adjusted capital. Okay, we are going to adjust the capital on the basis of the new partner's capital. New partner effective capital is 54,000. So the total capital is share is 1/4. So 16/4. New ratio is 16/4. 4/16. And so the total capital is 54,000 into 16/4, or the 4, 1/4 his share, and so 54,000 into 4. Okay, that is 2,16,000. In either way we can do. We can do 54,000 into 16/4. That is also 54,000 into 4. Okay. His share is 1/4. So the total capital is 54,000 into 4/1. Okay. So that is the total capital 2,16,000. So Sun's new capital is, the new share of Sun is 9/16, and so 1,21,500. Moon's share is 3/16, 2 lakhs. This is the capital, that is total capital of the firm. 2,16,000 into 3/16 is 40,500. Star's new capital, already we have, this is the base capital, and so it is 54,000. So this is adjusted capital. The capital of the new firm is adjusted on the basis of the new partner's capital. Then the next one is revaluation account. Here the land and building revised value is 60,000. The actual value in the books is 45,000. So it is appreciated up to the extent of 25,000. It should be credited. Then the sundry creditors is reduced to the extent of 1,200. Provision for bad debts is reduced to the extent of 400 rupees. And so all these things will come under the credit side. Then plant and machinery, the revised value is 60,000, book value is 70,000. So depreciation is 10,000. So the profit is 26,000 minus 10,000 is 26,600 minus 10,000 is 16,600. That should be distributed among the old partners in the old ratio. 16,600 into 3/4. That is the old ratio of Sun. 12,450. Moon is 1/4. 16,600 into 1/4 is 4,750. So the revaluation account should be prepared in this way. Then capital account. Balance brought down is 50,000, 80,000. The new partner brought capital of 60,000. Out of this 60,000, he brought a premium amount to the extent of 6,000, and so the entry would be Star capital account data to Sun capital to Moon capital in the sacrificing ratio. So Star capital account is reduced to the extent of, or debited to the extent of 6,000 rupees, and Sun's capital account should be credited with 4,500 and 1,500. This is the treatment for goodwill. And then revaluation profit is 12,450, 4,150. General reserve is 10,000. 10,000 is distributed among the Sun and Moon in the ratio of 3:1. That is 7,500 and 2,500. Then the capital this is the revaluation one, this is the premium, goodwill premium. Okay, this is also the goodwill premium, treatment of goodwill premium. Okay, then already we have calculated the capital. This is the adjusted capital. We have calculated the capital of the old partner on the basis of the new partner capital. The new partner effective capital is 54,000. So the old partner capital should be 1,21,500, 40,500. So here the son's capital is, actual balance is 50,000, 12,450, 7,500, 4,500, that is 74,400. But his capital should be 1,21,500. So the adjusted capital is more than that of the actual capital, and so his current account should be debited to the extent of 47,050. 47,050 is the difference between adjusted capital and the actual capital. Next, let us see the case of Moon. Moon capital is 80,000 plus 4,150 plus 2,500 plus 1,500. The actual balance is 88,150. But adjusted capital is 40,500. Adjusted capital is less than that of the actual capital. And so his Moon's capital account should be credited to the extent of 47,650. Okay. So in this way we have to prepare the capital account. So, current account, the current account of the partners should be credited or debited on the basis of the adjusted capital. This is the balance sheet of Sun, Moon, Star as on 31st. Creditors not likely to arise is 1,200. So, that should be debited. 70,000 minus 2,200 is 68,600. Capital, adjusted capital, we have already calculated 1,21,500, 40,500 and 54,000, that is 2,16,000. Moon current account should be appeared here, that is 47,650, that comes under the liability side. Then cash, 10,000 is the balance in the book, 60,000 is the cash brought by the new partner. Then debtors, so the total is 70,000. Debtors 35,000. Provision is actual provision in the book is 1,000. That is reduced to the extent of 400, and so 600 rupees should be debited or should be reduced, and so the balance is 34,400. Stock 30,000, investment 26,000, plant and machinery 70,000, but the revised value is 60,000, so 10,000 is the depreciation. Then land and building is 65,000, that is the revised value of land and building. Current account of Sun will appear under the asset side, that is 47,050. So the total of balance sheet is 3,32,450. In this way we have to prepare the balance sheet of Sun, Moon and Star. I hope you all understand how to prepare capital account, revaluation account and balance sheet, and how to calculate a new profit sharing ratio and sacrificing ratio and all. Thank you very much. Now let's see question number 4. A, B, C are partners sharing profit and losses in the ratio of 2:2:1. Balance sheet as on 31st/3/2020 was as follows. Creditors under the liability side, creditors 51,400, outstanding liability 6,000, general reserve 26,000, capital 48,000 A, B's capital is same 48,000, C 20,000, total capital of the firm is 1,16,000, cash 4,400, sundry debtors 22,000, stock 47,000, furniture 26,000, land and building 1 lakh. The total of the balance sheet is 1,99,400. Additional information. The partners have agreed to take D as a partner. New partner name is D with effect from 1/4/2021. On the following name, the T bring 20,000 towards capital for 1/5 share of profit. So the share of the profit in partnership firm for D is 1/5. Value of goodwill will be fixed as rupees 60,000, but D cannot bring any cash for goodwill. He failed to bring cash for his share of goodwill. Value of stock should be increased by 10,000. Provision for bad debts should be 10% of debtors. Furniture to be depreciated by 10%. Value of land and building should be increased by 20%. Prepare revaluation account, capital account and balance sheet of the new firm. These are the information that is given for the preparation of the P&L adjustment account or revaluation account. Let's see how to prepare revaluation account, capital account and balance sheet of the new firm. This is the working note for calculating new ratio and sacrificing ratio. Old partner name is ABC. Old ratio is 2:1. New partner name is D. His share is 1/5. New ratio calculation. Let the firm profit be 1 because the sacrifice that is made by the partner is not given. D's share is 1/5. So the remaining profit is 1 minus 1/5 is 4/5. The concept behind this one is the remaining profit should be shared between the old partners in the old ratio. So the remaining profit is 4/5. A's old share is 2/5, 2:2:1, 2/5. Therefore 8/25. Then B's the remaining profit is 4/5. His old share is 2/5. So the new share of B is 8/25. C's share is the remaining profit is 4/5 and his old share is 1/5, and so the new share is 4/25. 4 into 1, 2, 5 into 5, 25. This share 1/5 is already given. The denominator is 25 and so it should be multiplied with 5/5. So the new ratio of the partnership firm is 8:4:8:5. And sacrificing ratio is old ratio because the sacrifice that is made by the old partner is not given, and so the old ratio becomes the sacrificing ratio. Also, students need not calculate sacrificing ratio. This is goodwill treatment. First we have to calculate the D's share of goodwill. Total value of goodwill is given, that is 60,000. D's share is 1/5. So 60,000 divided by 5 is 12,000 rupees. But he failed to bring cash for goodwill. 12,000 he didn't bring. And so his capital account is debited and old partner's capital account is credited in the sacrificing ratio. Because why we have debiting and crediting the capital account? Because in this problem, in this firm follows the fluctuating capital method, not fixed capital method. If a firm follows a fixed capital method, then instead of capital account, we have to debit and credit the current account of the partners. The journal entry is D's capital account debtor 12,000, to A's capital account 4,800, to B's capital account 4,800, to C's capital account 2,400. So the sacrificing ratio is 2:1. The goodwill amount which is failed to be brought by the new partner should be debited and credited to the old partner in the sacrificing ratio. Now we have to prepare revaluation account. To provision for bad debts 2,200. Stock is 10,000 rupees. And then furniture is 2,600, reduced to the extent of 2,600. Land and building appreciated at 20%. So value of the land and building is 1 lakh. 1 lakh into 20% is 20,000. Stock is also increased by 10,000 and so it should be credited. Then the revaluation profit, the total of the credit side is 30,000. So 30,000 minus this 2,200 and 2,600 is 25,200. 25,200 is the revaluation profit that should be distributed among the old partners in the old ratio. Here is the working. 25,200 into 2/5 is 10,080. 25,200 into 2/5 is 10,080. 25,200 into 1/5 is 5,040. So A's capital account is 10,080. B's capital is 10,080 and C's capital account is 5,040. In this way, we have to prepare the revaluation account and the revaluation profit is 25,200. This is the capital account of the partners. First one by balance, opening balance. That is balance which is given in the balance sheet. A is 48,000, B is 48,000, C is 20,000. D brings cash to the extent of 20,000. So D's capital account debtor, that is cash account debtor to D's capital account is the journal entry. So cash 20,000. He brings cash for 20,000. So that should be credited. Then the revaluation profit already we have calculated. That should be credited because it is an income for the partners. So their partners capital account, old partners capital account should be credited. 10,080, 10,080, 5,040. General reserve total is 26,000. That general reserve profit or general reserve or profit which is remaining in the partnership firm should be distributed to the old partners in the old ratio. So the old ratio is 2:2:1. So 26,000 into 2 by 5 is 10,400. So in this way we have to prepare the capital account. Then this is the goodwill calculation. So goodwill calculation, D is a share of goodwill treatment. D is a share of goodwill is 12,000. Then this share of goodwill he fails to bring, and so his capital account should be debited to the extent of the sacrificing ratio of the old partners. So that is 4,800, 4,800, 2,400. If we add 4,000 plus 4,000 plus 2,400, 4,800 plus 4,800 plus 2,400, we will get 12,000. So these capital account should be debited. So D's capital account debtor to A's capital account to B's capital account to C's capital account. So specifically I have changed the color in order to make you to understand. Okay, this is the red color specifies or the represents the goodwill treatment. Okay, so here we have debited the capital account of D, and here we have to credited the capital account of A, B, C in the sacrificing ratio by D's capital account 4,800, 4,800 and 2,400. Okay, so the total of the balance sheet is 73,280, 73,280, 32,640, 20,000. So the total, the balance of capital is 73,280, 73,280, 32,640 and 20,000 minus 12,000 is 8,000. This is the effective capital. Okay. Actually, after the deduction of the amount which he failed to bring, the capital account, the balance of capital account which is remaining is 8,000 rupees. This is the way to prepare the capital account. Balance sheet. Balance sheet. Asset side. Cash. Balance in the balance sheet is 4,400. D brings cash for 20,000. So the cash, total cash is 24,400. Sundry debtors 22,000. Provision is 2,200. We have to deduct. If we deduct, we will get 19,800. Stock appreciated. So 47,000. It should be added. 47,000 plus 10,000 is 57,000. Furniture 26,000. Depreciate 10% depreciation 2,600. That has to be deducted. We will get 23,400. Land and building 1 lakh. Appreciated 20% and so 20,000. So 1 lakh in plus 20,000 is 1 lakh 20,000. Here creditor there is no change, 51,400. Outstanding liability also the one and the same, 6,000. Capital already we have arrived 73,280, 73,280, 32,640 and 8,000. The total capital of the firm after the admission of D is 1,87,200. This is the balance sheet of a firm after the admission of D. The total of the balance sheet